Hey everyone, Jason here again, and today I'm going to be talking to you about two things. I'm going to talk to you briefly about the price to earnings ratio, or the PE ratio, and I'm going to do a quick analysis and recommendation of JPMorgan. So let's go to webcam. So I hope you enjoy the mustache, just in the Movember spirit. I'm actually not raising anything for charity. I was just curious what I looked like with a mustache. So let's talk about the PE ratio, and this is one of the most important ratios, and it's the price to earnings ratio. So pretty much this is for every dollar you're buying the stock for, how much earnings are you getting from the company? So if the PE ratio is 10, that means you're paying $10 for $1 of earnings every year, right? And the thing with the PE is pretty much the lower the PE is, assuming earnings remain stable, you're getting a higher yield and for the earnings. So the way to calculate that is you just do the reciprocal. So if you're paying a PE of 10, you're getting a 10%, 1 over 10 earnings yield, right? And ultimately what a business is it's an earning machine, and the earnings are what pays you, right? So in general, the lower the PE, the better, right? And what's also interesting about the PE is sometimes if the stock is undervalued, not only will you get the higher earnings for the price you paid continuing throughout time, but the PE ratio usually has a point where it rests. So some companies' PE is usually around 20. So let's say for some reason the PE is at 10, you're also going to get the capital gain to restabilize the price to earnings ratio. You kind of follow what I'm saying. All right, so now let's talk about JPMorgan. So I was reading the Wall Street Journal today, and I saw some bad press about JPMorgan. So I did what I always do, and I checked out their company. So let's take a quick look at this company. Go to quote. Pretty much, if you look at it, the first thing I look at is the PE ratio. Okay, so here it's 11.7, so that's pretty low. So assuming their earnings remain stable at this level, I'll get I don't know, maybe around a 7% return, something like that. I don't exactly, but it's basically 1 over 11.7. So now I want to see how the earnings have been over time. So I go to the income statement and I check it out, and what I notice is they had really low earnings in 2008, and then their earnings are slowly rising. Now, that's interesting quantitative data, but what's really interesting about JP is that they were actually bailed out for the government. So that pretty much means they're not going to go bankrupt, which is good because they're a financial company. So if you just check out, where is it? Quote maybe. Anyways, I wanted to see a description of the company, but it doesn't really matter. It's a financial company. So if you look at these earnings, they look like they're rising over time. Now, is this what I would wonder is, what were the earnings like before the crisis in 2008? Because chances are the earnings back in sometime over here is what their normal earnings are like. These are probably just their earnings slowly recovering after the government bailout. So if you look in 2005, they actually have these types of earnings. In 54, these are millions. 54, right here. Versus if you go over here, 21, right? And you'll see even in 2004, 43, in 2003, 33, and if you go to 2007, it's 54, 2006, 60,000. So I haven't looked very deeply into the earnings, but just based on this alone, based on the huge type of company JP Morgan is, I mean, you can assume that their earnings are going to raise greater than this. So chances are their earnings are going to increase above this level, which means you're paying an even lower amount for these earnings. Now, if you check out key ratios here and go to 10-year summary, notice something interesting. The average price to earnings ratio. You can see in 2008 it was 37.59, which is way overvalued. For some reason it's pretty low. It's kind of low here. You know, it's low here. It's kind of low here. It's higher here. So they have a very volatile price to earnings ratio, right? So in 2012 it was 7.9. But you can see here it's low. I think it's somewhere. I would guess it's somewhere higher than on average than what it should be now. All right, and if you look at their other ratios here, you'll see their price to book. Meh, it's not doing that good. Debt to equity, they're a financial company, so this is different to analyze. Book value per share, you can see it raises steadily over time, which is always a good sign. So let's look at their cash flow statement really quickly. So cash flow from operating activities, positive, really huge in 2009, positive. Investing, negative, positive, probably has to do with the government bailout. What's interesting is these numbers are probably very skewed because of the government bailout. What I would say though, what I would say about JPMorgan though is chances are their earnings are going to return back to normal. You know, deeper analysis is required, which I've done a bit of, and I would say that yes, their earnings are going to raise above their current level, and because of that, you're going to see a rise in the price. I also believe that their price to earnings ratio is a little bit understated. So not only will we get the capital gain from the earnings rising, which will raise the price, but you also get a little bit more from readjusting the PE ratio around where it should be, right? And you can look more in depth in this also by looking at competitors. So the PE ratio should raise the price and the earnings. And not only that, you're paying a lower amount for a future large earnings, so you're also getting a higher earnings yield, a higher dividend probably. So overall, I would say so far JPMorgan looks like a great company to buy at this time. You know, it would have been great to buy even a long time ago. Chances are they're not going to go bankrupt. They got bailed out. You know, the government's not going to let them go bankrupt, so it's pretty much impossible. It's going to happen or near impossible. And their earnings are going to raise once their business operations return to normal. And their price to earnings ratio, in my opinion, is still a bit understated, so that should increase too. Right now, I would say if you have some extra cash and no better alternatives, I mean, I haven't spoken to many so far, JPMorgan Chase is looking like a good buy.